Hey everybody, welcome back to the channel. This is Ben Morales, your personal financial coach. And today I want to highlight why getting a mortgage can be one of the worst financial mistakes that you can make if you don't structure it the right way. In actuality, it can put your money in a trap that you just won't be able to get out of for potentially 4 or 5 years initially, and then it gets worse over time, or it can get worse over time. So one of the things that's bad with a mortgage is when you only put a small percentage down, and when you buy the home, the bank is going to look for ways that they can protect themselves for all kind of risks. So the less down payment that you put down on the home, the more of a risk you are going to present yourself to the bank. And they have created things to make sure that not only are they getting you upfront with the interest costs, but that their interests are also protected. So the banks have created what's called an escrow account. And they're doing you this favor by collecting payments for your taxes and insurance for you and then sending the payments off. So that's what this video is going to be about, is what is a mortgage escrow fund and why does it exist? Well, basically, in a nutshell, what it is an agreement between the borrower, which is you, and the lender, so the bank that you went to get your actual mortgage from. Now, the borrower, they send the funds to the lender, who then, and this is the key word, they hold those funds. Those funds are held over a period of time. Now, when those funds get released, that depends on when you did the mortgage, and those funds are held basically until the payment is due. Those due the items that are due with those payments are typically going to be your taxes and insurance. Now, the key thing with those two, when you get a mortgage, you're going to hear a phrase that's called PITI, principal, interest, taxes, and insurance. Well, the TI portion of it is the taxes and insurance, and those are usually due only yearly. So why is the bank collecting on a monthly basis those two fees, or those two payments for you throughout the course of the month? Well, the lender requires it. They're going to protect themselves and their interest, right? Remember, you're going to the bank, you're asking them for 97 or 95% of the value of the home. They're going to look to protect themselves. They're going to protect the interest in their property. They're going to retain all the control that they can, as much of control as possible. They want it for themselves, because remember, if you were not if you do not keep insurance on the home, and let's say something were to happen to the home, there's a fire, it gets destroyed, then who's going to be on the hook for that? The lender is going to be on the hook for that. Matter of fact, if they find out that you don't have insurance on the home, they will go and pick an insurance company for you, and they'll send you the bill. Trust me, they will do it as soon as they found out that there's no mortgagee clause designee. They will assign one for you. And again, they're doing this because if something happens to the home, they want to make sure that they get paid. And the same holds true with the taxes, right? They want to make sure that you pay the taxes, because if you don't, then it gets filed as a public record, or someone will find out. They can potentially buy a tax lien or put a tax lien on your property, become now the owner of the home, and that would put the owner in a second, or the bank rather, in a second position. So if the home goes to foreclosure, it's going to be sold, the bank now has to wait, right, for the short sale, the foreclosure, to then get paid. And no bank wants to be in second position. That's why the banks are not in the business to hold homes. They're in the business to lend money. So that's why they're going to take those steps, create that fund to make sure that their interests are protected. So it's required for all FHA loans and any loan that where you put 20 or less than 20% down. So even if it's a conventional loan, if you put less than 20% down, the lender or a third party they choose, they're going to create this escrow account, and on a monthly basis, they're going to charge you for it. So what they won't tell you, what they won't emphasize much times, is that when the borrower reaches 20% equity, it may be waived. And this is very true. Depending on the bank that you have, the lender that you have, they may waive it. Typically, it comes with a fee. It's a cost for you to waive it. And if they can't waive it, most of the time that means they can't do it unless you do a refinance. Well, what's wrong with that? If you have a lower interest rate because you bought the home 4 years ago and now the interest rates are 2 points higher, that means that if you have to now refinance, it might be at a cost of either the fee they're going to charge you or the cost of the higher rates, according to what is being offered to you in the market. So I want to show you exactly how an escrow account can actually impact and trap your money and keep it there trapped for working for the bank instead of working for you, that you could potentially use it to pay down the principal of that home in a first position HELOC. So this is a client that I'm working with right now, and their payment on a monthly basis is $1,761.43. Now, it isn't bad enough, right, that the bank, they got this mortgage, right? They got what they felt was a good interest rate, but they didn't see all this in the background what was happening, right? Because though they making this payment, only $255.97 is impacting the principal every single time they make a payment, because they're still very early in this mortgage. It's only about 3.5, less than 4 years. And then on a monthly basis, $683 is actually being applied toward interest. So the bank is loving it, right? Now, on top of that, if this wasn't bad enough, now they establish an escrow. So the escrow, $369.23 every month is going to taxes. $162.92 every month is going to insurance. They have a PMI, right? They were the perfect client for the bank because all this holds true. Less than 3% down. We're going to collect for taxes. We're going to connect for insurance for the yearly payments that have to be made. And then what happened is when they first bought their home, that was not their payment. That payment every year since they've owned the home has been going up. Why? Because there has been a shortfall, the shortage in the escrow, because taxes have gone up, insurance costs have gone up, and who's flipping the bill on that? Well, the client is, right? But the bank is doing them the favor and holding them the funds. So when you have an escrow account, I'm sure if you have a mortgage, it may happen to you because it's starting to happen a lot in the market where people are seeing increases of 3 and 4 or 500, even $1,000, sadly, depending on where you stay. That's exactly what happened to them throughout the course of these 3.5 years. There's been a shortage, and now the bank is trapping an extra $822.46 every single month that's being held, right? And instead of them being able to leverage this to do something more positive and have a positive impact in their principal and pay that principal down, now they have to retain or keep those funds. The bank is keeping those funds until one time a year to be able to do them the favor and make that payment to the escrow for them. So we already can see what the total monthly cost is. I'm curious to find out. Let's find out what the yearly cost would be, right? What that favor, how much that bank favor is costing us on a yearly basis for them to hold that money for us. So it's $822.46 every single month that's taking place. Over a period of 1 year, we're looking at additional costs that are being held that could potentially be going toward paying off your mortgage, right? Potentially be going to impacting your principal on a monthly basis, especially if you start to leverage the velocity banking strategy that I talk about on this channel. That's what the cost is coming at, right? So now we don't have to pay those on a yearly basis, right? That those funds could be used more adequately, more efficiently to pay down mortgage principal until they're actually needed, right? One time a year, or maybe the taxes 2 times a year, like here in Illinois. Then you send the payments there. Okay, so in my opinion, it makes no sense to keep them trapped for a year in these cases and really serving the bank and not serving you. How do you get out of it? Well, don't be discouraged. If you're in the market to buy a home, my 2 recommendations are: number one, save 20% so that you can avoid this whole escrow thing to start with, right? Save yourself 20% down, then go purchase the home that you're planning to purchase with that 20% down, and you will fall into this particular category. Second thing, if you don't want to go that route, then use either a first position HELOC. And when you do a first position HELOC, you will not be required to do the taxes and insurance, meaning that you stay with the money in your pocket. Then you can use the first position HELOC, implement the velocity banking that I talk a lot about in this channel, and pay that loan off in 5 to 7 years, or consider all-in-one type of loan, which would also be more advantageous for you because it will help expedite you paying the loan off in a much, much quicker way. So I hope this information, this video helps you a lot. Don't be despaired, but be on the lookout. Be careful before you make a purchase of a home using a mortgage loan. Get yourself educated. Look at other options. Follow this channel. Like, subscribe, share. Continue to give me some feedback on the things that you would like to see on the channel. I'll be sure to put them out on there as quickly as I can. So until then, the next video, take care and God bless.